This is Rick Rule for the Rule Classroom and Rule Investment Media, sponsors of the 2025 Rule Natural Resources Investment Symposium, July 7 through 11 in Boca Raton or via live stream from the comfort and convenience of your own home. Perspective of how you attend, there's a few things you need to know. The first is that we're going to present between 50 and 55 hours of programming over 4 days, more than you can possibly absorb over 4 days. To that end, conference tapes will be available to you for a year afterwards, and discussion groups at the Rule Classroom will cover various aspects of the conference. Further to that end, we interview every exhibitor and every speaker at the conference before the conference so that you have the ability to familiarize yourself with the opportunities and the topics that will be presented. The more you put into the process, the more you will take out. We encourage you to allocate your time at the conference efficiently by listening to all of the pre conference interviews, determining what is of specific interest to you, and reaching out to the companies even before the conference so that you can allocate your time at the conference more efficiently. A couple other things you need to know. At our conference, unlike any other investment conference I know of, every single exhibitor is owned in the accounts of the conference sponsors. While this represents a conflict of interest to some, it is your guarantee that at our conference, every single exhibitor has been vetted. That's a very important thing for you to know. The fourth thing for you to know, probably, if you're considering attending the conference and watching these pre conference interviews, is that our conference, unlike any other conference on the planet, your tuition comes with an ironclad money back guarantee. If for any reason you don't think that you got your money's worth attending live or via live stream, email us. We will refund the money. So let's get on with the process. Today's interview features Marc Lafleche from Ecora Royalty. As stated earlier, I am a shareholder. Please understand that. Marc, thank you, first of all, for your ongoing sponsorship and support of the Natural Resources Investment Symposium.
Well, it's an absolute pleasure, and we're delighted to be attending this year for the first time, actually, Rick. So thanks for having us.
You'll find our audience is well versed in royalty and streaming, so they will be receptive, as they should be, I think, to your pitch. Tell us something, first of all, about yourself. Establish some credibility so that people are eager to hear more about what you have to say.
Yeah, well, from a royalty sector perspective, I've been now with Ecora for a long time. It doesn't feel like a long time, but it's been almost 11 years in various roles in the business development function, and then more recently as CEO. And previously, I worked at Citigroup, investment banking, which is not too dissimilar, I think, to many who worked in the royalty and streaming sector, covering natural resources sector. But also, I had the opportunity there to do just under a year in leverage finance. And I didn't know it at the time, but the combination of natural resources with leverage financing is quite a powerful tool when you think of the royalty and streaming product, which sits somewhere between debt and equity. So it's been a great journey with Ecora and an exciting time for the business, I'm sure we'll speak about shortly.
Well, let's do that. Why don't you give us an overview of Ecora? In particular, what you see as your specialties and your competitive advantage relative to other royalty and streaming companies in the space. You'll find us predisposed to the royalty and streaming story generally. We want to know specifically about your royalties and your streams, and specifically about how your strategies differ from your competitors.
Yes, in that sense, Ecora is quite unique or differentiated. Our strategy has been to take a portfolio which historically was very weighted to coal, and reposition it to create a royalty company providing exposure to critical minerals. And that's quite different. You know, there's certainly no shortage of precious metals focused royalty companies, but in this basket, it's a much smaller group of royalty and streaming companies chasing after these commodities. So we've gone from historically almost 100% coal exposure to today, from a net asset value perspective, more than 50% copper, which I'm personally really proud of and very excited about, given the outlook for copper and the outlook for Ecora to benefit from that copper outlook. But more generally, it permits folks, I think, who are looking for critical minerals exposure in the royalty model, and you can do it with Ecora. In that sense, Ecora is probably a new company or emerging as a new company from what was an old company, very focused on coal in the past, still with some good cash flows to come from our coal royalty, but increasingly as we look to the future, critical minerals and copper are really dominating our revenue profile. And in fact, 2 years from now, subject of course to where commodity prices are on a relative basis, analysts are forecasting for our copper royalty income to be our #1 revenue generator.
And can you describe briefly the most important assets? And I think it's probably important to include Kestrel, although it may be an asset of the past. It's part of what finances the future.
Yes, so Kestrel in many ways has financed a lot of the acquisitions, and Kestrel is a phenomenal royalty in many senses. It's a royalty that's derived by an interest in the surface rights. So what you'd have at Kestrel is not a royalty that's set at a constant royalty rate, but a royalty rate that's set by the government of Queensland, a state in Australia. And at its highest end, when coal prices in Aussie terms are above $300 per ton, our royalty entitlement is 40% of the revenue. So you can imagine that this asset has generated quite a lot of cash flow. At its peak, when met coal prices hit $200 and $600 per ton in 2022, that royalty generated $110 million. So looking back at our P&L, anyone could be forgiven for thinking that this business is heavily dominated by coal. As we look to the future, mining operations at Kestrel will continue, but moving out of our royalty entitlement area. And so we still have volume growth year on year from 24 to 25, some good chunk of volumes next year, and then a tail of income thereafter. So the Kestrel royalty is, in other words, depleting. And in parallel, we have ramp up of a critical minerals portfolio. And to give you a few data points, in 2020, our base metals portfolio generated probably less than 5 million, critical minerals less than 8. Last year, that was significantly up. And then by the end of the decades, there's potential for that critical minerals or base metals portfolio to achieve under 100 million of income. Of that, probably 50-ish from assets that are already in production. Something new absolutely emerging from something old, but the met coal cash flow is absolutely quite a lot to give.
Because of the relative maturity of your royalty portfolio relative to peers in your market cap, you have been able to pay a dividend continually. My friend Doug Casey wonderfully describes dividend payers, that is, earned dividend payers like yourself, as exhibiting, quote, outward manifestations of inward grace. If you could talk about the royalty and the policy with regards to royalties, dividends and sustainability.
Yes. So our dividend framework, our dividend policy is part of our wider capital allocation framework. And our dividend policy was updated last year as part of a capital allocation update. And currently, we distribute 25 to 35% of free cash flow, and that's paid on a half-yearly basis. We foresee that dividend growing along with our royalty income, and thus our strategy is not to increase shareholder returns by virtue of a higher distribution of the same amount of free cash flow, but to grow dividends as a constant percentage of a growing free cash flow number, which is far more sustainable.
Marc, let's talk about the value proposition. If you are free to discuss third-party estimates of your net present value relative to your enterprise value, and also on a trailing and to the extent that you're able to forward-looking basis, what the yield is given the dividend and current share prices. The investors might say, what have you done for me lately?
Well, it's an interesting one, actually. And that's really the crux of the opportunity I see personally at Ecora, and in part is why I personally have been acquiring as many Ecora shares as I can. The equity to trade is trading at less than the implied value as estimated by research analysts than our producing asset base, which is an anomaly in the royalty and streaming sector. And I think in part it's a function of a changing portfolio and met coal being out of fashion. The share price today is at 58 pence. The producing asset base is estimated net of our debt at just over 70 pence. So, and beyond that, our high quality portfolio of growth, which is estimated at 70 pence, is effectively for free in the current share price today. So from a value entry point, to buy this portfolio or to get access to the portfolio as an entry point for less than the value of the producing portfolio, and then to potentially benefit from all the growth that exists in the portfolio, ranging from near-term growth projects that are permitted and effectively shovel-ready to longer-dated growth things, royalties in our portfolio. Like, I'll give you an example, NextGen's Patterson Quarter East, which is one of the most prospective uranium discoveries, maybe in the last decade or longer. None of that really is priced in. So that's in my opinion, anyways, a really attractive entry point.
And I think it's important to note that given the fact that the royalty consumes between 25 and 30% of free cash flow, the probability is that in addition to the undeveloped royalties and streams, you have the ability to add new product. I'm assuming that's accurate.
That's absolutely the case. And while we focused on the dividend distribution as part of our capital allocation framework, we see a great opportunity to keep growing our royalty portfolio. I mentioned this to you when we were pre-interview, but it seems like the current market conditions are such that there's a degree of just general choppiness at a macro level, combined with a desire from the mining sector, in particular, as critical minerals and base metals, to continue to proceed with capital projects. And that just creates a great confluence of factors for our business model and opportunity to continue to acquire high quality royalties and streams.
And this asset you're suggesting, this opportunity, is available at a substantial discount to liquidation value. In a sense, one could say it's a half price sale. What is the current yield? What rent do you pay people on their money for the ability to participate in this bargain?
Back on a 12-month backwards-looking forecast, dividend yield was around 3 to 4%. Now, of course, on a forward-looking basis, difficult to predict given it's not a fixed dividend, right? It's a floating. You'd be in probably, I think it's based on analyst consensus, somewhere around 3%, with, of course, the potential to grow substantially as growth assets come into production in the future, and as you mentioned rightly, as we continue to grow the royalty and streaming portfolio.
It's unusual for a small cap company to be in a position to pay these royalties. And it's important for our listeners to know that while they're buying something that will grow in the future, they're getting paid rent now. They don't have to worry as much about the time value of money to be patient because they're getting paid rent.
Yeah, the royalty model is a bit interesting in that sense because Ecora, we have an enterprise value just over $300 million. So in that sense, we're small cap. But the royalties and the folks who own the mines or developing the projects over which we have royalties have market caps, if you add them together, an aggregate of $200 billion. So Ecora itself is a small cap royalty company, but the portfolio provides exposure to some of the mega caps, some of the largest mid-tier copper producers, and other names that are really household names and well known. It's a nuance point. But it's one of the virtues and beauties of the royalty model, in my opinion, to get access to some great projects via the relatively de-risked royalty model.
Marc, thank you once again for your ongoing support and sponsorship of our symposium. If the listeners want to learn more about Ecora, who in particular do they contact and how do they contact that person?
Yeah, it's really straightforward. So the email address is ir@ecora-resources.com. And that email address will go to Jeff Callow, our head of investor relations, who, we will look at that question. Either he'll pick it up or I'll pick it up, but that's the best way to reach out to us.
Marc, once again, thank you. I look forward to hosting you at the Natural Resources Investment Symposium, July 7 through 11 in Boca Raton. Thank you for subjecting yourself to this interview.
No, it was a real pleasure, Rick.